Welcome to The Explainer. Today, we're going to dig into a business paradox that is so powerful it can turn a production boom into a multi-billion-dollar bust. Seriously, it's a concept that goes against one of the most basic instincts in business. I mean, it just makes sense, right? If you want to make more money, you just make more stuff to sell. But as we're about to see, in the real world, that simple strategy can backfire in a huge way, sometimes causing entire industries to lose billions. All right, so here's our game plan. We'll start by busting the production myth that trips so many people up. Then we'll dive right into the paradox itself with five dramatic real-world examples. After that, we'll figure out why this even happens, and then wrap things up by rethinking what growth really even means. Okay, first up, the production myth. Let's break down that simple, intuitive logic that tells pretty much every business to just ramp up production. You know the drill. The goal is simple: increase revenue. And the path seems just as simple: increase production. More products should mean more sales, which, of course, should mean more money. On paper, it's a perfect equation. But, and this is a big but, it's missing a really critical piece of the puzzle. And this is where it gets really interesting, because there's another part of this equation, and it has the power to flip that simple logic completely on its head. It all boils down to this one fundamental formula. See, your total revenue isn't just about how many things you sell. It's actually a delicate balancing act between the quantity you move and the price you can get for every single one of those items. And this slide just perfectly illustrates the paradox in action. So look at the left. A small 5% price dip is no big deal. When you sell 10% more stuff, your revenue still grows. Great. But now look at the right. That same 10% sales increase forces prices to drop by a whopping 20%. And suddenly, you've actually lost 12% of your total revenue. You are literally working harder to make less money. Wild, right? So, you might be thinking, okay, that's a meat math problem. But this isn't just some hypothetical. This exact scenario has played out time and time again, and it has shaken up some of the world's biggest industries. First up, let's talk about the global oil market. Back in the mid-2010s, there was a huge boom in U.S. shale oil production, and it just flooded the market. But the result wasn't a big payday. Nope, it was a price crash that sent shockwaves through the entire global economy. Let's really look at the numbers here, because they're staggering. The world was actually producing more oil. We're talking an increase from about 87 to 94 million barrels a day. But check out what happened to the price. It got slashed by more than half, from $108 a barrel all the way down to just $52. And the result? Absolutely devastating. The total market revenue was nearly cut in half. It dropped from $3.4 trillion down to under $1.8 trillion. Ouch. And hey, this isn't just a story about fossil fuels. We see the exact same pattern in renewable energy, specifically the solar industry. During this period of intense investment, factories were just churning out solar panels, expecting this huge green gold rush. But instead, they created a massive oversupply. Just look at these figures. The industry more than doubled its output, right? From installing 16 gigawatts a year to 38. That sounds amazing. But the price per watt totally collapsed. It fell from $3 all the way down to just 80 cents. So what was the consequence? The entire market's value actually shrank by over a third. They made more, and the market got smaller. Now, if we go one step deeper into that solar supply chain and look at the raw material, polysilicon, well, the situation was even more dramatic. This is a textbook example of overinvestment just leading to a total market collapse. The numbers here are even more stark. Production went up by a pretty healthy margin, from 180,000 to 250,000 tons. But the price, it just fell off a cliff. We're talking a staggering 75% drop, from $60 a kilo down to just $15. This completely wiped out any benefit from the increased volume, and it caused total revenue to crash by an incredible 65%. But this paradox isn't just for, high-tech gadgets or energy sectors. It also hits agriculture, and it hits it hard. Take cocoa. Between 2014 and 2016, all this increased output from key growing regions created a global surplus. And in this case, even a pretty slight market surplus was enough to trigger a really sharp price drop. The price per ton fell quite a bit, which meant that the farmers in the countries producing all that cocoa saw their collective income fall from nearly $15 billion to under $11 billion. That's a painful 26% decline. Okay, and our final example is one that's happening basically right now. Lithium. It's absolutely essential for batteries in electric vehicles. And as the EV boom took off, companies rushed to expand production to meet what they thought would be just limitless demand. And this is just the perfect summary of the whole paradox. In just 1 year, lithium production surged by an estimated 30%. But that flood of new supply caused prices to drop by an even larger 32%. So again, the math is just unforgiving. Producing more led directly to earning less, with an overall revenue drop of nearly 12%. So, you have to wonder, why does this keep happening? Well, it's not random. It turns out there are 4 key conditions that create a kind of perfect storm, making an industry really vulnerable to this paradox. First, you've got high unit value products. Think oil, think lithium, stuff where even small price shifts have a huge financial impact. Second, production just skyrockets way past demand. Supply just grows much, much faster than the market can actually absorb it. Third, you've got what's called high price elasticity. This just means the market is super sensitive, so even a small surplus can cause prices to totally plummet. And finally, high fixed costs. These industries, they require massive upfront investments. So companies get desperate to produce more just to cover those costs, which of course only makes the whole problem worse. Okay, so all of these examples really force us to take a step back and confront a pretty fundamental question about how we even think about business growth. When you get right down to it, it always comes back to this simple but incredibly powerful piece of logic. If the percentage you lose on price is bigger than the percentage you gain in sales, you are going backwards. Plain and simple. Growth in production does not automatically mean growth in revenue. And that really leaves us with a final thought to chew on. Maybe the most critical strategic question a business can ask isn't how much can we make, but instead, how much can the market actually bear? It's a subtle shift in thinking for sure, but it's a shift that could be worth billions.